Welcome back to Your Finance TV. For regular viewers, you know the guest that we have here today. But for those who haven't been on here before, welcome to Jay Pelosky on Your Finance TV for the first time.
Indeed, Scott, great to be back with you, and congrats on the new venture, and hopefully it goes well. And TPW Advisory and myself personally looking forward to being on the journey with you.
Well, thanks very much, Jay. And Jay, listen, we always start off this show looking at your title of your musings and so forth. And listen, I understand all about foggy weather because we've had a lot of it this week. But why are your musings titled Foggy Weather this week?
Because we've had a lot of it. I mean, you're going to have something that everybody can relate to, at least around the New York metropolitan area. And you're constantly thinking about, okay, what do you want to write about as the week progresses? And so I was biking, as I do normally, pretty much every day. Big fan of city bikes here in New York City. Biking up towards my office, and I ride up Broadway. So for those of you who really know New York, that's against the flow of traffic, but that's not a surprise for TPW and Jay Pelosky, right? We typically go against the consensus. For you newbies out there, that tends to be our direction. Counter consensus and contrarian. So riding against traffic up Broadway, looking at the Empire State Building, and it's a beautiful part of my day. I mean, usually if it's sunny out, the whole huge building is, bathed in early morning sunshine and sunlight and all that. So just so pretty, so beautiful. And some days though, it's the very tip is obscured by low-hanging clouds. And some days, as this particular day early this week, I think it was Wednesday, maybe yesterday, I think Wednesday, it was completely covered in fog. You could not even see anything of the Empire State Building. It was as if it didn't exist. And it got me thinking that, that's kind of how we are with the markets right now, right? It's foggy weather. And then I extended it into the old analogy about driving in fog, right? Cars stop, they start, they slow down, they move to the right, they follow other cars, but much more slowly. And everyone's afraid of a big crack up, one of those things you read about every spring, right? 500, 100 cars, 20 cars, 50 cars. So that's where I think we really are in the markets. If you extend the analogy, just think about stop and go traffic in lousy weather. Okay, what have we done in the markets? We had December, it was a stop. Right? Pretty ugly month, capped a really ugly year. What was January? It was a go, right? Risk assets, and we're back to talking about meme stocks and, things of that nature, as if 22 never even happened. And where are we in February? We're kind of chopping around, trying to figure out what the next direction is. So to me, I think amidst all that, we need to pay attention to a couple of things. And the things that we're paying attention to really are three. One is the continued outperformance of non-U.S. equity versus U.S. during this choppy period of pullback in risk assets, right? So that's one that's really important to us because we're positioned that way. We believe that we're in the beginnings of a secular multi-year move towards non-U.S. equity outperformance. And that leads us to the second point, which is the dollar, right? The dollar plays, we believe, is going to play a key role in this move towards non-U.S. equity outperformance. And so we're right. We had a big dollar rise last year, very strong, up I think 15% DXY, and now we have had a pullback of about 5%. And over the last couple of weeks, as rates have backed up, the dollar has strengthened. And so we're watching the 106 level in particular as a key consideration there to start. If it breaks through 106, that would suggest by technical analysts, better technically than I am for sure, that maybe the dollar is going to go to a period of strength, which would retard certainly that non-U.S. performance and retard the commodity space, which is another space where we continue to be fairly strong. And so those are the two things. And then the third thing, obviously, is the Fed, in the likelihood of the Fed, going much beyond what markets have priced in. So those are the three things amidst the foggy weather. Those are the things we're kind of paying attention to.
Jay, listen, you know I'm an old equity guy from way back, so fixed income really isn't my strength. But the rates have pulled back aggressively. Like, what's your thoughts on that?
Yeah, it's been very aggressive. The market kind of priced out the recession, right, and is now kind of pricing in. We went from recession to now we're worried about the Fed having to raise Fed funds to 6% or more, right? We've already priced in, and I think this is important. We have priced in a lot of bad news, or what's considered bad news, right? Which is, CPI been a little stronger than expected, certainly in January. Jobs report was stronger than expected. Retail sales were stronger than expected. And then today we get PCE and consumer spending, likewise, stronger than expected. So we have gone away from the recession towards overheating and discounted an awful lot in between, and left us with a fixed income market that was up 7%. I just checked this morning, Scott. Barclays Ag 3 weeks ago was up 7% year to date, and now it's down roughly 1%. So these are tremendous, stop and go, up and down moves, which again, we at TPW Advisory do not think we have the trading chops to trade in and out around this stuff. So our game is, as you know, having a point of view, defending it with the data, looking forward, and positioning for that point of view to play out. We're not in the business of trying to trade at, Barclays Ag for 7% monthly moves. That's a challenge which is beyond us for sure.
Well, one of the things you also do touch on is the middle path. Now, for those who haven't seen you before, can you touch a little bit on that, and
Sure.
also what you're seeing on that middle path?
Yeah, no, that's a great point, and it always makes me smile, Scott, when I recognize how well you read our stuff, right? I mean, anybody that's thinking about going with your finance TV, Scott reads the stuff, all right, and so he can ask the right question, and he even has a memory, so he remembers that way back in the summer we were writing about the middle path, and what was the middle path? What was and is. It's a path between ever higher inflation, which was the problem worry back in the summer, and recession, which was the worry as we moved into the fall, right? We've never been a buyer of either thesis. Our view is that we're moving in this middle path where inflation is going to come down and the economy is resilient enough to avoid recession. The US economy is resilient enough to avoid recession. And we continue to hold to that point of view. We expect inflation in the first half of this year in the US to continue to decline, driven by very easy year-over-year comps on the goods side, right? Let's remember, we're all talking about the Russian invasion was 1 year ago today. So the February, March, April 22 inflation prints had those huge spikes in energy and food, et cetera, in them. So February, March, April 23 should be very easy comps, okay? So that's the story, we believe, of how inflation is going to play out in the first half of the year. The second half of the year is going to be driven by a sharp decline in the cost of shelter, right? And here we already know this has happened. It just takes a while for the data to get fed into the official kind of CPI process. So we know that rents in the US have fallen 8 months in a row through December and are off by roughly half the rate of increase, off by roughly half of what it was at the peak, which again was, the early part of the second half of last year, the summer of last summer. So that should lead to easy comps. So that's the inflation story as we see it playing out. The recession story, we beg to differ. We look at things like the Citi US Economic Surprise Index, which is going higher and has been going higher, turned up a couple of months ago. So, and we don't see, as we pointed out last summer, no major imbalances in the US. Consumer is fine, right? Record low unemployment. Still have money left over from the COVID stimulus process to work through, okay? Corporates are fine. Huge amounts of cash on the balance sheet, huge. Buybacks in the first couple of months of this year, Scott, are running at record levels. Corporates have tons of cash. And then third, banks are fine, right? The banking sector in the US is rock solid. There's no worries. I mean, JP Morgan just cut what they expect the default rate to be for US high yield last week. They cut it from 3% for 23 to a 2% default rate. So there's no imbalances that typically tip the US economy into recession. So we are of the view, even though Bloomberg consensus is calling for a recession in the US right up through the latest, summing up, which was last week, we don't see a recession in the US.
Okay, so for the investors and traders that are watching this, and even just the general public, just listening for some your insights, where are you focused on the investing side then, after all, taking all that in?
Yeah, and that's really what it boils down to, right? I mean, everybody can have a point of view, but at TPW Advisory, we offer several model portfolios, and a lot of my personal investment money is in those portfolios. So our clients at TPW Advisory and myself, we eat the same cooking. So we have a global multi-asset model, which looks at, invest in stocks, bonds, and commodities around the world and currencies. And we have what we call our TPW 20, which is a 100% thematic model, which looks at things like climate, future tech, demographics, infrastructure, et cetera. So in the flagship, which is the global multi-asset, we have three strong points of view. The first, as I touched on, is we are significantly overweight non-US equity versus US. And that includes both DM. Last year, we were very focused on Europe. This year, we're more focused on Asia, particularly in Japan, amongst the DM developed markets, but also EM. We spent a decent chunk of the fourth quarter last year adding to our emerging market positions. So we have positions in China, we have positions in Southeast Asia, we have positions in Brazil and Mexico in emerging markets. So that's our first big bet. We're overweight non-US, in large part because they don't have an aggressive Fed. I mean, certainly, okay, ECB is going to continue to raise, but we have to remember that Asia, Bank of Japan is not, they're still holding to yield curve control, right? We think that's going to change as the year progresses, but at the moment, they're not raising rates. The PBOC in China is pumping liquidity into the system to stimulate as they exit zero COVID. I believe we wrote about it in last week's musings that China year to date, this is an amazing statistic. Year to date, China has provided 3 times the liquidity that they did over the last 2 years. In 2 months, 3 times the liquidity provision for the Chinese economy, which obviously spreads out into the world, than over the last 2 years combined. So we have a desynchronized global economy, right? And we believe that Asia is starting to grow again. China is going for growth. We expect the Chinese economy to grow about 6% this year, for example. Japan, PMIs are above 50 in Japan. We think Japan is going to continue to grow in 2023. Europe, PMIs are above 50, right? And consumer confidence has been up 5 months in a row and is the highest it's been in a year. So when we think, U.S. investors in particular, given the outperformance of the U.S. Equity market versus the rest of the world over the last decade, everybody is overweight the U.S. And so the trend now is to move away from the U.S. because the non-U.S. markets don't have a huge growth bias, right? Don't have 25% in big tech, which is going to be limited by high interest rates, right? We do not expect the Fed, and the market has kind of now priced this in, we do not expect the Fed to be cutting rates in 2023. Okay. We do not expect a recession. So no rate cutting. So rates remaining high cap the upside for big tech growth stocks, which, because they represent a quarter of the S&P, caps the S&P. That leads to a flattish year for the S&P, plus or minus 5–10% is our view. But interestingly, Scott, that's the best environment for non-US equity to do well. Okay, because we all know US goes up, nobody cares about the rest of the world. US goes down big, everything goes down. So non-US equity is a big focus. Significantly underweight fixed income is another big focus. That's how we pay for the overweight in equities. And then overweight commodities as well, on this view that we're about to enter a new global growth cycle led by Asia, and in particular China. So we remain overweight commodities, and that's been a little painful, to be honest, right? I mean, oil has not done particularly well year to date. Dr. Copper just had a fender bender, as I wrote about it in the musings, right, down pretty big this week. So that's a little bit concerning. So you have to pay attention. Markets are definitely back and forth, stop and go. But we're looking at the technical levels, and technicals for non-US equities still remain very supportive, virtually everything above their 200-day moving average. That's important. Watching that dollar level, right? We touched on 106, and the DXY is an important level that we're watching. And seeing the non-US equities continue to sustain outperformance during this choppy period is a validation, we believe, of the argument that non-US equity is going to take the leadership baton, has taken the leadership baton, and is going to hold it for a period of years, which is typically how these things go.
Well, Jay, listen, it's been great. I've missed you. Like, it's nearly 2 months since we've spoken.
It has been, and you know what? You look better than ever, buddy.
You look great too, mate. Listen, thank you so much for your time. Have a great weekend. And for everyone watching, make sure you go to jaypelosky.com to go check out all of his musings and much, much more.
Thank you, buddy.
For everyone else out there, good luck investing.